Buy early, buy often. If you can cash flow at all. So first off, make your money on the front end, buy the doggone property. And when interest rates go down, refinance it and cash flow more.
Maybe just give us a quick intro about who you are and what you're up to and what you think's working really good for you.
Yeah, great. So I'm a retired police officer of 13 years, retired military officer of 34 years, former mayor of Cinnaminson, New Jersey. I'm a real estate investor and licensed agent. I operate in New Jersey and Pittsburgh primarily. We have a number of single family homes and several commercial multifamily, smaller multifamily deals. I was a real estate investment coach for Tariq Al Musa. I still teach the Burr method, commercial multifamily analysis, property management, velocity, and infinite banking. I specialize in those. I've underwritten personally about $100 million worth of deals. I have a personal real estate portfolio of several million myself. I'm the president of Aim High Properties, and I own 8 subordinate companies to Aim High, which ranges from small single family properties to commercial multifamily properties out to hair salons.
That's fantastic. Wow. That's great. I mean, you've done quite a bit. That's really exciting. How long ago was it that you got started?
October of 2018 is when I started to kick off my real estate journey. And in January of 2019, I picked up and started flipping my first flip. By the end of January, I had 3 doors.
Yeah. So you've done a lot in just a few years. You've really taken this to a whole new level.
Yeah, it's the military way, man. You pick up something that somebody's done, codify it, document it, create standard operating procedures, processes, procedures, and checklists, and then execute.
Boy, I'll tell you what, I found that to be so true in real estate. If you can be a very process-driven person, and if you're not, like if that's not naturally you, and you're not so much an integrator, maybe you're more of a visionary. I tend to be kind of more like big picture guy. I tend to not enjoy so much, down in the weeds.
Yeah.
But if that's either you or you can bring on somebody into your team that is that person, what I've noticed is the most successful real estate companies, businesses, investing businesses that I know, they've got someone in the team that's really honing in on the processes, the systems, the procedures, the stuff that's kind of boring that nobody really wants to do, or, most people don't want to do, or maybe tend to not like to do. But it really is the success in this business really is in the details. Would you agree with that?
Oh yeah, absolutely. Once you have your processes and procedures done, execution becomes real simple. It's just checking the appropriate block and making sure that you're following through.
Yeah, that's so true. In fact, I often tell people before you can ever scale a business, wholesaling, flipping, any type of real estate business where you're looking to take a model, like if it's the Burr method where you're gonna buy it, renovate it, refinance it, or really any rentals, creative, whatever it is, if you want to actually take a model and monetize it in a consistent way, then before you can ever start hiring before you can even start marketing at a bigger level, anything, you better really dial in your processes. You better have a system in place that you really understand well. Because if you don't, the minute you go to scale, you're going to create all kinds of havoc in your life and in your business. And I see that happen again and again. That's actually very common where people start to scale too quickly. And it's not a speed thing. It's more of a, are you ready thing? They start to scale before they're really ready. And that can actually be detrimental because now you're creating all these leads that you don't know how to manage well.
Yeah. I've made the mistake not scaling fast enough. Then I scaled too quickly, and now we stepped back, downsized a little bit, and we're in the process of scaling a lot more slowly.
Yeah, I think it really too comes down to a conscious effort and very intentional about what it is you're trying to create. I know for me, I tend to gravitate more towards the low overhead, less volume, more margin model. And that's served me very well over the years in my real estate business. Not that you can't do volume and margin, or not that there's not a place for volume. And I've certainly had times in my career where volume's been a very big part of the business. But if I take one step back, or if I look down at my own personal journey, or my personal preference, I would say that I much prefer doing bigger deals, bigger margin deals, and less of them than a high volume, small margin business. Which one have you gravitated more towards?
Yeah, Jared, we started out doing single family properties and started doing a lot of them. And then, after flipping about 100 deals between the actual flips and then retaining some of them, executing the BRRRR strategy on those, we started looking at somewhere between 5 and 20 doors at a time, commercial multifamily units, simply because we can do exactly the same process in exactly the same timeline with a lot more doors at once, but it's only one building, basically.
So in other words, what you're saying is if you do a 10 unit and that's one deal, it's sort of, not quite, but it's sort of the same amount of work as doing maybe one single family deal.
Yeah, exactly.
You're leveraging 10 doors instead of one door.
I find it easier to get a loan for a 10 unit than I do to get a loan for a 1 unit. It's a lot less paperwork, a lot less hassle overall. You're still running the same number of contractors. Your stabilization period is going to be a little bit longer, but for the most part, it's, I get what you're saying. It's not exactly the same amount of work, but it's pretty close. You're just running the same contractor or contractors, depending on how long it takes you to get each unit stabilized. But yeah, once we started moving on that, right now we've got a 6 unit that I'm jumping over to right after our call here.
Yeah, and that applies within multifamily, and that applies really within even single family. For example, flipping a $500,000 house is just as much work as a $100,000 house, but you're going to make 3 or 4 times as much money. Or I'm doing some hotels here in Puerto Rico, and I've got a 9 unit that I'm closing on this week, and it needs a renovation. And then I've got 2 30 unit deals I'm trying to put together. And when I look at the 30 unit hotel versus the 9 unit hotel, it literally is the same amount of work. I mean, I've got to do a full rehab on the 9 unit, but it's a team, it's contractors, it's budgets, it's stuff, materials, and it's capital, it's a closing, right? It's raising money. Everything's the same, except one's going to give me 9 units and the other one's going to give me 30 units. More zeros, obviously, like it's more capital, but other than that, it's kind of the same amount of work. And so when you kind of grasp that concept, it can be a real game changer.
Absolutely. And my experience, I found that the better my team, the easier it is on the larger units than, having a smaller team and having to take on some of that responsibility myself on the smaller units.
Yeah, totally. Yeah, that's a really great concept to grasp. For me, that changed the game completely because I started out doing kind of low income wholesaling and flipping.
Yeah.
And when I transitioned up into a couple price points higher, I literally made 3 times as much money on the one flip that I did on all the flips I was doing before, per deal. And I caught that vision, and it completely transformed the rest of my life because I continued that trajectory of like doing higher end deals and bigger size deals. And so I'm really glad that I kind of caught that vision and took that path. For you, since you're doing a combination of flipping and holding, how do you decide, hey, let's flip this one and hey, let's keep this one? How do you make that decision?
Yeah, it's basically just a cost basis analysis. What we look for is how long is it going to take me to get my money back in this deal? So if there's something that, say, I'm going to earn $50,000 on a flip or versus I'm going to earn $500 per door, majority of the times I'm going to take the $500 per door for the next 30 years, simply because I'm going to earn that much more money in the long run. But if it's a slam dunk flip where I'm going to make, $70,000 in a couple of months and turn this property over quickly, and then I can turn that property, take $35,000 and buy one over here, $35,000 and buy one over there, that's a no-brainer. It kind of boils down into that. It's a combination of numbers, kind of gut, and and then a cost benefit analysis.
Are you so I'm imagining that your flips are also helping fund your keeps, right? Your holds.
Yeah, I do that. I do flips for 2 reasons, Jared. I do flips first to generate some extra income, just to get more properties. And then the other reason is to keep my contractors happy if we do have a lull in between, bar properties.
Yeah, especially when labor's been kind of tight, having ready and accessible crews is a big deal. If you're in the real estate business, because when you need them, you need them, and if they're busy for 6 more months, then it really puts you at a disadvantage. We found that during COVID, where it was nearly impossible to get contractors. We ended up bringing a lot of them in-house, or maybe not W-2, but we committed to always have work for them to be, our exclusive contractors. And so that put a lot of pressure on to make sure that I had the next project ready to go. It was a good pressure, but it was pressure to have work for our contractors. Now, having said that, I've seen a lot of flippers, rehabbers take on deals just for the sake of keeping their contractors busy. And that's not a good business model either, just to turn dollars. So if you can make sure that you're always profitable doing that, then that can be a smart way to do that. But I love that, because what's great about flipping is you can make it the end all be all, like you just flip and you don't really get into other things. I've actually done that for a lot of my career. And it's great because, you create all this liquid cash and you can fund your lifestyle. It's amazing to, be making really a lot of money. But what I think you're doing is really wise. And you're also saying, okay, well, short-term cash is great. That's amazing. It allows me to do a lot of things, keeps me nimble, keeps me flexible. I mean, nothing's better than having a padded bank account. That's amazing, right? But at the same time, flipping's transactional. So at some point in time, if you want to pare back, and you haven't built productive assets that are producing cash flow and income, then, you might find yourself at a place where you've made a lot of money, but you've got nothing to show for it anymore. Right.
Yeah. You can't write a check from a building. And I've explained that to my wife as our net worth has increased. And there have been times where maybe we had 3, 4, 5 projects going on in a month, for flips, for that transactional cash. And we've stopped doing that. In fact, we're getting ready to finish our last flip overall. And then we've got 11 rental units that we're currently renovating. And in all honesty, man, you find yourself cash strapped way too quickly when you're flipping on volume.
Because what's happening when you're doing that?
You're waiting for draws. You're counting on contractors to hit their metrics in certain periods of time. And if they are off by a week or two, now we have a liquidated damages clause in our independent contractor agreement. So if a contractor goes over 14 days, he starts getting charged $100 a day on his fees. And we do that specifically because our average cost is somewhere around $100 a day. Right now, it's actually closer to $2 right now on interest. And, having your KPIs in hand and at, right on a spreadsheet in front of you helps a lot to figure all that stuff out. But you got to get in, you got to get out, you got to get out quickly. Sorry, I had a train of thought there and I kind of just lost it for a second, but what
you're saying is when you're flipping, it's so cash intensive because it's just all money out until that day you sell that property. And then it's an influx of money. What you're saying is that cash out for the period of time can be very draining on a business. If you're not, especially if you got multiple deals going on.
Yeah, especially when we're dealing with we're taking charge of all of the materials costs specifically because we don't want people to mark that up, and they will mark that up. Your contractors will definitely give you a markup on your materials. So what we do is we split it in the very beginning. Hey, how much do you think this job would cost overall? Now, if I was buying the materials, what's your labor only charge? And then so I'm a service disabled veteran, I get 10% off for that. I'm also a licensed contractor, I get 10% off of that. So my materials cost is generally 20% less. And if you're marking stuff up 10 to 20%, there's a huge discount on that.
And if you put it on your credit card, you get the points on your credit card.
Yeah.
So you get there's a lot of win there to buy your own materials. We do the same thing. I'm not able to get some of the discounts you are, like the veterans discount, but even still, we've almost gone exclusively to where we buy all materials from all subs. And mostly just I want the points on my credit card, so I can fly my family around the world how many ever times a year for free.
Yeah.
And I'm paying for it anyway, minus the markup. So why not? Why not buy it and I earn the points on the credit card, right?
I think last week we made 2,000 in Chase Inc. points because they pay like between 1.5 and 3 times, right? Or 3%. And then on my American Express Platinum card, in October, we took 21 days and toured the Greek islands.
Yeah.
just on points.
Yeah, that's cool. I mean, that's really great. And you're paying, like I said, you're paying it anyway. Why not earn the benefit of it?
Exactly.
Yeah. So that's great. So tell me a little bit about your BRRRR strategy. Is that still effective working right now with high interest rates, or is that kind of put a damper in that model for you?
No, if you listen to Pace Morby, he'll tell you that it's dead. But no matter how you do this, you're going to wind up taking a loan in the front, whether you're taking it from your own bank account and putting money out, or you're actually taking a loan from a hard money lender, or you're using private money, whichever way you decide to do this. And even if you do get like a creative finance deal where you're taking over somebody's mortgage, and you still have to find a way to pay for the rehab, right? So as long as your numbers are solid when you're walking in the deal, it works. It still works. So we're purchasing it at a discount. We're purchasing distressed properties, and then we're going to go in there and rehab it, rent it out, refinance it, and then pull whatever we can pull back out of it. And hopefully we don't go cash broke while we're doing that.
And when you're doing BRRRR, are you using private money on the rehab, self-funding the rehab? How are you doing that?
Yeah, combination of all, right? Okay. So we'll use our vetted lenders for hard money, or we have a list of potential private money lenders. We just paid somebody today $55,000 on a deal that we just finished. It's simple 10% interest on that particular loan. In some it's you sweeten the pot a little bit. Maybe it's 10% on the front 6 months. If you go over 6 months, it goes to 18 or something like that, just to get somebody to a little bit more incentive to come into the deal. But for the most part, we're 3 to 4 months on a flip.
Yeah. So you guys catch that. What he's doing is he'll find a distressed asset, just like, everybody does, whether you're a wholesaler, flip, or whatever. He'll find that discounted distressed property, fund that purchase, however you fund it, either hard money, private money, your own cash, but you got to buy it. Now you got to put cash into the rehab before you can rent it. So now you got money coming in to do the rehab. Again, that can be private money. It can be part of hard money. It can be some of your own cash or wherever you're getting the money. Once you've now bought it, renovated it, instead of flipping it, if you're going to keep it, then what you're going to do is you're going to go do a refinance. And there are specialized lenders that will do these refinances for you. And are you using DSCR loans? Is that what you're doing?
Yeah, for the most part, we're either using DSCR, commercial. Every once in a while, we'll flip a HELOC into the mix, depending on what the situation is. They're very difficult to get, and we can only do one at a time. And the only reason we do that is so that we have that ability to go back and use the equity on one of the properties to pay for something else later on. Yeah.
So in case you guys don't know, how would you describe, Bud, a DSCR loan to somebody who doesn't know what that is?
Yeah, so a DSCR loan is essentially the ratio between what you're paying, what you're bringing in rent, and what you're paying out to your mortgage. So it's essentially your rent divided by your mortgage payment. And if you're at 1.25 to 1.3 times your mortgage, then a bank will lend it to you. What we're looking for is a minimum of 1.3. Personally, we look for a minimum of 1.3. If you look at if you're familiar with the 1% rule in New Jersey, because our taxes are so high, it's quite similar to the DSCR loan. So for whatever reason, we wind up with our purchase price, that 1% rule. It's more like a guideline, not necessarily a rule. I've seen it work in both different directions, but we're still looking for that 1.3 times our mortgage payment.
So let's break that down. So DSCR stands for debt coverage. Debt service
coverage ratio.
Yeah. And again, like Bud explained, what the lender is saying is the lender is basically saying, look, if the rental income can easily service the debt, the loan, the mortgage payment, then we'll go ahead and give you the loan. Mm-hmm. But we want to feel comfortable that, the rent that you can collect is going to easily pay for the loan. And so it's, in a way, it's sort of like a hard money loan in that it's less about you, more about the deal, right? So a traditional loan from a traditional bank is going to heavily weigh their decision on lending you money based on your own personal credit, your income, your job history, all the things, which is brain damage. And they're going to limit you on the number of deals you can do. And they're going to make you put a big down payment, all the things. Now you'll get a great interest rate, but it's really hard to grow a rental portfolio using traditional financing. At some point, you're going to basically cap out and they're not going to lend you anymore. So what a lot of investors do, like what Bud's doing, I do this as well, is get into the deal. So get your acquisition figured out, rehab, purchase and rehab. Then you're going to go to one of these DSCR lenders, and assuming that your deal meets the criteria, they'll refinance. And when you refinance, now you pay off that acquisition and rehab money, wherever those funds came from, pay those off, right? That way you can use temporary money to get in, a DSCR loan to exit out. Does that make sense? And so that's kind of how those work. Now, are you able to cash out 100% when you do the refinance, or are you usually leaving some money in?
Yeah. So most times we'll take it right up to about that 75 to 80%. Okay. Now that's not all the time. So if I find and I do this on purpose because we don't want our percentages to go up. Like, we don't want to be so leveraged that we're sitting somewhere above 70% overall on leverage. And then
the cash flow is too tight.
It is. It's way too tight. And what we don't want is, God forbid, we do see the housing market, drop a bit. You get a call, and that's never good for anybody. With 2012, 2008 to 2012, that's what was happening. They were
where they call the loan?
Yeah, exactly. So they were saying, "Hey, all that money that you owe us, we want it now." And people were just leaving their keys on the island and walking away.
What happens, and the reason why they're able to do that is, in loan covenants, one of the loan covenants is that the loan is never more than the equity or the value. So if the market drops enough that your loan, now you're upside down, technically a bank could call that loan due because it's violating one of the loan covenants. And that's what we saw happen in the past is that happens. So you don't ever want to put yourself in that situation if you can help it.
Right. And overall, we like to stick around that 50 to 60%.
Okay. So when you're doing now fix and flip, and you're doing buy and hold, and you've got contractors now that are working in both things. Mm-hmm. Excuse me, I've been fighting this cold. How are you able to how are you able to separate those two business models? Because I found that they're actually very, very different business models in a lot of regards. Maybe not buying and rehabbing, but running a flipping business and running a buy and hold business, there's such polarized strategies. Mm-hmm. That do you treat them like two different businesses, or do you just everything goes in the same pot at the end of the day?
Yeah, no, and they're completely different businesses. They're completely separate. Yeah. So we have, a few different companies that deal with our rental properties, and we have a couple of different companies that deal with our flips.
Gotcha.
Never the two shall meet. Specifically, we don't want to have one pot have liability compared to the other pot, because it takes one lawsuit to take the rest of the houses,
Yeah. So what Bud's talking about, you guys, is asset protection. And this is something I'm really big about doing, which is, I utilize a lot of LLCs to buy properties. Mm-hmm. And so what I do is I set up kind of like what you just described. I set up separate entities per business strategy. So even within my real estate business, I've got multiple companies. And what I like to do is I like to just create a parent company that's going to do that strategy. So like wholesaling, its own entity, flipping, its own entity, hotels, its own entity, rentals, its own. And now you're going to have multiple entities, multiple books, multiple bank accounts. That can get a little tricky. You need a good bookkeeper and to do that. But even then within that, I'll actually take title to properties and sub LLCs that are underneath the parent companies, giving me another layer of asset protection. Are you doing some of that as well?
Property trust. Yeah, we were using
Yeah.
a property trust system. Jerry, to put it in perspective, I don't like to flip. I'm kind of selfish when it comes down to it. But yeah, keeping with that idea that we keep those separate. We have, in fact, different key performance indicators specific to our particular model. So when we're looking at a rental property, we're looking at somewhere between $10 and $25 a square foot to rehab a rental property, and we're looking at similar but different. We're looking at somewhere between $10 and $85 for a flip.
Yeah. So you're going to spend more money on a flip usually.
Absolutely. Because we want that thing to be, pristine when somebody moves in. As a rental property goes, contractor grade is fine. Luxury vinyl plank versus hardwood floors, stainless steel, bottom of the line Kenmore in a kitchen for a rental property versus, top of the line Vulcan range for some of our flips.
Yeah, you might leave those windows, or you might paint the cabinets. You might do some things like that because it's a rental. Yeah, definitely. Well, that's fantastic. How are you feeling about 2023? What are you seeing on the horizon that you think is a great opportunity, or is it just business as usual? Keep going the way you're going.
Yeah, I'm still bullish, man. I'm looking at this and I'm applying the Warren Buffett rule. So when people are fearful, be greedy. And when people are greedy, be fearful. And right now everybody's afraid. So I'm buying.
Yeah, I think I've taken the same approach. We've actually, doubled down even more since the market's corrected, because I think now's the opportunity. Now's the time to pick up some great deals. And if you can structure things correctly and be set up and buy right, for me, it's all about buying right. If I know I'm buying right, then even if the market corrects, I'm sitting in a good position. So I think that's a smart move. A lot of people are sitting the sidelines. I know we've seen a lot of cash buyers exit the market, and all that's meant to me was great, more opportunity to go after.
Yeah. And the other thing is this: collaboration over competition. I have no problem reaching out to other investors in my area, having conversations with them, finding out what they're doing, what systems they're using. Maybe they have a deal that they can't pick up right now, but I can. What I'm seeing is a lot of beginner buyers leaving the market because they're scared to death.
Yeah.
And then you have the experienced investor who's left sitting here, and I don't want to say it's leveling off. It's really kind of not. We're still now in my area, South Jersey. North Jersey's vacating, Manhattan's vacating, Philadelphia is vacating, but a lot of people are gravitating towards South Jersey. We do have still all of the jobs in the area, so it is an anchor area. We're not seeing the level off or the decline in value as some of the other places are. So we're still seeing, 10 to 20% over asking price on wholesales and MLS purchases.
Yeah. Yeah. We're do you know where, oh shoot, I'm trying to remember now. I can't remember the city. It's a Jersey property that we're wholesaling for about 45,000. And I'm blown away at the buyer interest, the cash buyer interest we've had in that property. So I know that's a hot market. In fact, I think a lot of markets have weathered the correction very well. There's a lot of markets that are doing just fine, and properties are moving quickly. So, it might be very short-lived, this whole market correction. Well, Bud, that's awesome. Guys, leave a comment, say, Bud, you're a flipping genius. It really is amazing that you've built such a amazing business so fast in just a few years. I mean, what would you say to somebody watching right now that's maybe early on in their business, or they're just getting started? What would be your best advice to somebody, trying to build this business like you were just a few years ago?
Yeah. Right now it's buy early, buy often. If you can cash flow at all. So first off, make your money on the front end. If you can cash flow at all, buy the doggone property. And when interest rates go down, refinance it and cash flow more. Rents are going up, not down, and they're going up dramatically. And even when rents level off, they don't usually drop. They usually level off and stay the same for a period of time. So I don't see that changing anytime soon. I just had a 2-bedroom, 1-bath vacate. We were getting $1,150 from 2 years ago. It was a 2-year lease. And right now I can rent that thing out for $1,550 a month.
Yeah. Yeah, I think you're right. We're not building houses to keep up with the demand of buyers, of people coming online, the millennials and everybody. So rental demand is going to continue very strong, I think, for the foreseeable future.
Yeah. I mean, 6.5 is not that big a deal when it comes to interest rates. The fact that we're at 8.5 now, I don't care. Honestly,
Yeah.
And it's still buying, still cash flowing, and that's fine.
As long as you cash flow, then you can weather it, right?
Exactly.
That's great. Well, I love that advice. That's great. But it was awesome talking to you. Great ideas you've got, and really, really great way of how you teach and present. Guys, I'm going to put Bud's contact info in the description. A couple people asked Bud if that's okay. And Bud's actually active in social media, and he's actually putting out some training. He's got a YouTube channel. And I think you're on all the other social platforms. So Bud, let's be sure to get that information from you. I think I've got it, but I'll go ahead and put that in the description of the video, so you guys can be sure to follow and subscribe and start learning from Bud, because he's an amazing resource and doing some really cool things.
Yeah.
So thank you, Bud. Appreciate you so much. And guys, thanks for this call. Awesome call. And we'll see you on the next video.